In this video, we decode the matrix of the options chain. The options chain is the command center for every trade you will ever place. To the untrained eye, it appears as an overwhelming spreadsheet of fluctuating numbers. But for a professional, it is a precise map of market sentiment and liquidity. This interface displays every available contract for a specific underlying asset, organized by expiration date and strike price. Understanding how to navigate this matrix is not just about finding a price. It is about assessing the probability of profit and the cost of entry. Before we discuss strategies in Phase 5, you must be able to read this data fluently. Let's break down the standard layout, which generally mirrors across most brokerage platforms. The center column acts as the anchor, displaying the strike prices sorted numerically. On the left side, you have call options, representing the right to buy, and on the right side, put options, representing the right to sell. Each row corresponds to a specific strike, while the tabs at the top allows you to toggle between different expiration dates. Always confirm you are viewing the correct expiration cycle before analyzing the data, as liquidity changes drastically between weekly and monthly contracts. Moving outward from the strike price, the most critical columns for execution are the bid and the ask. The bid is the highest price a buyer is willing to pay, meaning this is the price you sell at. The ask is the lowest price a seller will accept, which is the price you buy at. The difference between these two numbers is the spread, which represents a hidden transaction cost or slippage. A wide spread often indicates low liquidity, forcing you to give up value just to enter the trade, whereas a tight spread signals a healthy, liquid market. To gauge the health of a specific contract, we look at volume and open interest, often abbreviated as OI. Volume tells you how many contracts have changed hands today. It is a measure of current activity and velocity. Open interest represents the total number of outstanding contracts that exist and have not yet been closed or exercised. While volume resets daily, open interest accumulates. We prefer trading strikes with high open interest because it ensures there is an established market of participants, making it easier for you to exit your position later. Advanced traders customize their chains to include the Greeks, which measure risk exposure. We will cover these deeply in Phase 3, but you should have delta and theta visible on your chain now. Delta estimates the probability of the option expiring in the money and how much the price moves relative to the stock. Theta displays how much value the option loses per day due to time decay. Having these columns visible allows you to make decisions based on mathematical probability rather than just the premium price. Another column you must monitor is implied volatility, or 4. This percentage reflects the market's expectation of future price movement for that specific strike. High 4 means the option is expensive relative to historical norms, often occurring before earnings events. Low 4 suggests the option is relatively cheap. When reading the chain, you aren't just comparing dollar amounts. You are comparing 4 percentages to determine if you are buying an inflated asset or a discounted one. Finally, visually, most platforms shade the option chain to indicate moneyness. For calls, strikes below the current stock price are in the money and usually shaded, as they have intrinsic value. Strikes above the stock price are out the money, holding only extrinsic value. This visual cue helps you quickly orient yourself to where the stock is trading relative to the available strikes. Be careful not to confuse the shaded area for profitability. It simply denotes that the option has intrinsic value at this moment. Reading the chain is a skill that improves with repetition. Start by verifying liquidity through the bid/ask spread and open interest before you even look at the price. Configure your columns to remove clutter and focus only on the Greeks and data points that influence your strategy. In our next few episodes, we will look at how order types interact with this data to ensure you get filled at the right price. Remember, the chain is unbiased data. Your edge comes from how you interpret it. Thanks for watching, and see you in the next episode.